How much money do you really need to start trading in 2026? One of the most common questions beginners ask is how much capital is required to start trading. While there is no universal answer, the key is how the amount aligns with risk management, expectations, and strategy. In practice, many brokers allow trading with relatively small deposits, sometimes as low as $50 to $100. A more realistic starting range for beginners is typically $500 to $2,000, as it provides flexibility to manage risk properly. Starting with too little capital often forces traders to take excessive risks to chase meaningful returns. Starting with too much can amplify emotional pressure and lead to costly mistakes early on. Your starting balance directly affects both your risk exposure and profit potential. With a small account, position sizes are limited. With a small account, profits are modest. With a small account, transaction costs and spreads have a larger impact. At the same time, smaller capital can be useful for learning because it reduces absolute losses. The key principle is to risk no more than 1 to 2% per trade, regardless of account size. Larger accounts allow for more stable growth and better diversification. Larger accounts require stronger discipline and emotional control. Before starting, it is essential to carefully evaluate trading platforms, including providers like SGoldmanIfa. When reviewing a platform, focus on transparency of fees and spreads. Also examine execution quality and available order types. Check the available markets and tools. Verify regulatory information and security measures. Reviews of platforms such as SGoldmanIfa can be helpful, but should not be the sole basis for decisions. Reviews often reflect individual experiences or marketing narratives that may not apply universally. Understanding how a platform actually operates is more important than relying blindly on opinions. Many beginners fall into two extremes about starting capital. Some believe they can start with very little and quickly generate large profits. Others assume they need a large amount of money to succeed. Both views are misleading because trading is a skill-based process. Results depend more on consistency and risk control than on initial capital size. Starting with a moderate, affordable amount of money you can afford to lose is generally the most balanced approach. The most important factor at the beginning is not capital, but mindset. New traders should approach the market with realistic expectations. They should focus on learning rather than quick profits. They should adopt strict risk management rules. Treating trading as a long-term process rather than a short-term opportunity builds discipline and reduces emotional decisions.